Chapter 7, risk analysis, real options, and capital budgeting. The key concepts and skills, understand and be able to apply scenario and sensitivity analysis. The scenario analysis and sensitivity analysis are part of your homework. Specifically the first couple of problems. We'll also be doing break-even analysis. Accounting and financial, probably the most important. We'll talk about Monte Carlo simulation. We'll talk about the importance of real options in capital budgeting. Understand decision trees. Layout of the chapter, pretty much what we just walked through. So, sensitivity analysis, scenario analysis, and break-even analysis. Each allows us to look behind, the NPV or net present value number to see how stable or volatile our estimates are. We can look at different changes and evaluate their likelihood and see, depending on how likely those possibilities are, we may choose to walk away from a project. When we work with spreadsheets, you want to try to build the model so that you can adjust variables in a single cell as opposed to in multiple cells. When I worked through the homework for both these chapters, I did it in a spreadsheet, and basically I started out with the first problem and I modified that spreadsheet for each question. And as you go through those questions, each time you are able to improve that spreadsheet a little bit, and so over time you create something that's actually quite flexible. So, example: Stewart Pharmaceuticals. So, Stewart Pharmaceuticals a corporation is considering investing in development of a new drug that cures the common cold. Corporate planning group, including representatives from marketing, production, engineering, recommended the firm go ahead with the test in the development phase. The preliminary phase will last 1 year and cost $1 billion. The group believes that there is a 60% chance that the test will prove successful. That if the initial tests are successful, the Stewart Pharmaceuticals can go ahead and with full-scale production, and this investment phase will cost $1.6 billion. Production will occur over the following 4 years. So if we have a successful test, this is in year one, we're going to invest $1.6 billion, and then in years 2 through 5, we'll have $7 billion in sales, $3 billion variable costs, $1.8 billion in fixed costs, $400 million in depreciation. So that'll lead to a pre-tax profit of $1.8 billion. We'll pay $378 million in taxes, which will result in a $1.4 billion profit. So cash flow is just I always do it the same way. It's the pre-tax profit, or EBIT, minus taxes plus depreciation, so $1.822 billion. So calculated NPV at year one at a 10% rate. That gives us a net present value of $4.197 billion. So this is only the successful side, and we have the unsuccessful side on the next slide. So same, if we after an unsuccessful test, we can still market the product. our revenues are going to be lower. Our cash flow is going to be lower. Um, the the NPV is ends up being negative $44 million. So so now we have to decide whether to test. If we go back to the first stage, so it boils down to the simple question: should we invest? Um, if we calculate the expected payoff, it's the probability of the two outcomes. So they assign a 60% probability to success, which has a value of $4.1 billion. If a 0.4 probability and of a $44 million loss, and the which equates to a expected payoff of $2.487 billion. So remember, this is as of period 1, so we need to bring it back to period 0 and get a calculator net present value based on that's the initial $1 billion that we paid for testing, and so we take that and calculate NPV using the 2.487 billion. We present value that back 1 year, and we get a expected NPV 1.261 billion. So now it comes down to the question of should we test. So we're going to look at sensitivity analysis. So we'll start the next lecture talking about sensitivity analysis.